For more on this dynamic, let's bring in RBC Capital Markets Global Head of Commodity Strategy, Helima Croft. She's also a CNBC contributor. Helima, we kind of know the headlines. Obviously, there's not a lot of detail around just how active or just how advanced the planning is for any possible move in the Middle East, especially Iran. What exactly are you hearing, and how exactly are you interpreting what we do know right now?
Well, we certainly know there's been a significant redeployment of U.S. military assets to the Middle East. And we do know that the president has signaled sort of new red lines for Iran over the last couple of weeks. They do the red line over how Iran treated domestic protesters. And he's also raised the issue about the missile program. This is very important for the Israelis. They have wanted to have significant curbs on Iranian missile activity. That is something now President Trump is pushing for. And you mentioned the foreign minister's statement saying he's ready for talks. He also said that he would not put the missile program on the table. So that is potentially a serious point of conflict between the U.S. and the Iranians. And again, we've already had a military engagement between the U.S. and Iran and Israel over the summer. If it turns into an actual regime change operation this time around, that is what is worrying market participants. Do we get something that becomes a more regional conflict as opposed to the contained one we saw over the summer?
It doesn't seem like it's that worrisome yet. I'm not trying to trivialize it. What I'm trying to put it is in context. We've already taken action about Venezuela. We've already seen some moves here with regard to moving military assets into place in the Middle East. What, from your perspective, if you were to try to scenario analysis this thing out, what exactly would be the next point of either escalation or de-escalation that markets would care about?
Don, one thing I would sort of point out to you is that the regional allies of the United States are taking this pretty seriously. The fact that you have Saudi Arabia's defense minister in Washington, I think, is a signal of how concerned neighboring countries are about a destabilizing conflict in the region, and concerns that regional energy infrastructure, economic assets could be targeted if this becomes a broader confrontation. So they are not basically playing this safe. They are trying to actively craft a diplomatic outcome. So what you want to watch for de-escalation are any signs that President Trump is walking back some of the demands on the missile program, walking back the zero enrichment issue. If the Iranians, by contrast, are willing to talk about making more serious curbs on enrichment activity, allowing international inspectors back into Iran. There have been no UN nuclear inspectors in the country since June. Those are the type of steps that we would look for in terms of de-escalation. But again, we have a lot of U.S. military assets now in the region. There is conversation about the U.S. potentially pursuing some type of regime change strategy there. Again, that is something that I think would make market participants be concerned about a broader conflict. We got lucky in the summer that it did not spread beyond borders. The question is, would a second confrontation be so contained?
Right. So, Helima, we also have the Venezuela issue. We're just looking there again at the prices. I mean, Chevron says they're going to ramp up production in the country by 50% in the next 18 to 24 months. Then Venezuela has signed a law this week opening their oil sector to privatization. So I think the question is, what does it mean both for the oil industry there, but also for the oil price and kind of for the barrels that will be available globally as we keep this Iran concern in the back of our minds?
What's important, Kelly, is that Chevron is producing 250,000 barrels. So if we're talking about a 50% increase, we're not talking off a massive base. And they're basically saying that is 18 to 24 months. And that is in line with what a lot of people are saying about Venezuela, that potentially in 18 months, you could get an increase of a couple 100,000 barrels out of Venezuela. But to move into more material gains, a million plus additional barrels, that's going to require a very stable security environment, a very stable contracting regime, and massive improvements in infrastructure and bringing back key personnel. So I still think that there is a more muted expectation from the key players about how much gains we can see in the near term. Again, a couple 100,000 is feasible. A million barrels is something that's going to require a lot of heavy lifting. And I just don't think it's an offset if we were to see something in the Middle East in terms of supply disruption. Again, no one is saying we're there yet, but given the deployments we've seen in the Middle East, given the fact that it's not clear we're going to find a path to a diplomatic resolution, are we headed into the second U.S. military conflict involving an oil producer this year?